Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Close Show. I'm Scott Carson. As always, excited to be here today as your host. On this episode, I thought I would dive in a little bit into some of the note investing segments or some of the different assets that note investors dive into, that they're looking to invest in. There's a variety of them because there's so much great stuff in the note space, different little niches that are attractive and affordable and a great place to park some money in the long run, if you know exactly what you're doing. Now, I'm not going to talk about markets because states are that's a whole nother show about which states are good, which states are bad, what's are attractive, what's hot right now, what's cold right now. That's a whole different episode that we'll dive into, but a great topic for later. This topic is about the different types of notes that investors chase. There's the first liens, there's second liens, there's residential, there's commercial, there's partials, there's owner finance notes. There's performing or non-performing. And so what I thought I'd do is I dive in a little bit each, talk a little bit about each. Not designed to be an educational piece on all the different note subjects or the different segments, because I still highly recommend that you look into those different segments and educate yourself depending on what your risks and what you're looking to do. And I'm going to be honest, give you the pros and cons of each one. So first, I'm going to start off with the non-performing notes. And I'm going to talk about what we do here at We Close Notes. My parent company, that's the big kahuna, I guess you could say, when it comes to what we do as far as education and workshops and things like that. And you can always find out what different types of education we have by going to weclosenotes.com. Or I encourage you, if you're listening to this, to go ahead and text the word notes, N-O-T-E-S, notes, to 72,000. That's a phone number. You can text it to 5 letters, 72000. That's notes, N-O-T-E-S, to 72,000. And then what we'll do is send you some videos and some links to some good stuff that you can watch and learn. But non-performing notes, what I like about non-performing notes, well, I'm only going to be buying first. We'll get into non-performing seconds in a second. But non-performing first liens, the big thing is that you're going to find stuff at a discount. That's one of the biggest things. Living here in Austin, Texas, which Austin, Texas is home, and I know it's different for those living across the United States or those listening in different markets that our show airs on. Each market is a little bit different. But Austin, Texas, for the last 10 years, I think has really been overpriced for the most part. So for me to find deals, stuff that makes sense as a yield play, I had to look at other markets. So that's one of the biggest things. There's a lot of inventory out there across the country. That's the first thing. Second thing I love about non-performing first lien notes is that all the profits, really, you have multiple ways to make money. 9 different exit strategies, from wholesaling to reinstating to allowing the borrower, have somebody take over the property, let them assume it, selling the note off, doing a short sale, doing a cash for keys, a foreclosure. You can also try to get them to reinstate. I mean, there's a variety of different exit strategies that are involved there. I think I'm missing one or two. Getting it reperforming. That's where you make your money, is either getting it reperforming or some sort of exit strategy that refers to you taking the property back or selling the property off. Those are probably what's going to happen. Now, performing notes, you're going to have it happen and have it go down the foreclosure route somewhere between 30 and 40% of the time, depending how precise you are in your due diligence and what you do, and what you do as far as your due diligence and borrower stalking or due diligence on your borrowers, besides just the asset itself. The third thing I like about assets, besides the fact that you find stuff all across the country with a lot of exit strategies, is the pricing point. We still find stuff usually cheaper than what most people else are going out and targeting, especially we'll get to some of the other asset classes later. But if you're buying non-performing, you shouldn't be paying above 65%. You should be paying below that. I prefer 50% of either the lesser of the as-is value or percent of UPB, 50% or less, whatever's less of either value or UPB on an asset. Now, UPB stands for unpaid principal balance for our listeners out there. Okay? Important to keep that in mind. Unpaid balance. Now, if you buy in an asset where the balance is less than the value, that's a cheaper amount. Some basic numbers. $100,000 house. If the mortgage is $80,000, well, if you paid 50 cents of value, then you're paying 50 grand, which is above the 50% of the true value of the house. All right? Now, or 50% of the UPB, my apology. Let me make sure and clarify that. Now, if the UPB is 120 and you're paying 60% of UPB, or 50% of UPB, that's paying 60 grand. on a $100,000 house, that's 60%. You would go then at 50 grand because it's over encumbered. I don't like to chase assets that have a lot of equity behind them because the fact is, it's not like a traditional real estate where you foreclose, you don't get all that equity. If you foreclose and it sells off at the foreclosure auction, the borrower is going to get the overage. So that's something to keep in mind. But I love the different exit strategies. Yes, foreclosures, it's going to happen a chunk of the time, but we try to alleviate that with offering cash for keys to the borrowers, some sort of financial incentive for them to walk without dragging the foreclosure on and things like that. So non-performing notes, that's what I like. That's what we've been buying for the last 10 years. Buying non-performing first, because that way the only thing that really wipes us out is the taxes. And we like to double check the taxes and make sure the taxes are paid. Or if we do, there have been times that we have used a tax sale to help us clean up an asset and take the property back, and either initiate or have the taxes get bid up at the foreclosure auction so that we see a tax overage take place and we're able to recoup that tax overage. It's a little bit timely. It's a process you got to look at. Can take a little bit longer, but it can be valuable, especially if you've got an asset that's got a lot of stuff on the books that may not get cleaned up. But anyway, non-performing first. It's a little bit easier to raise capital for. I know that some people are like, oh, I got to go raise capital. I'd rather use my own money. That's fine. I get if you're going to use your own money, but if you want to do some big things, you're going to use other people's money to take your business to the next level. All right? That's one of the big things out there that I would highly recommend for you. Now, another thing that a lot of people like to look at is non-performing seconds. There are some caveats to non-performing seconds. Yes, I have bought some seconds primarily behind my non-performing firsts when I was the first lien holder. We bought the second, offered a bit, pay off the second because the homeowner was working with us. That's when we're taking the property back, so it helped us expedite the foreclosure. Now, a lot of people with seconds, they're buying behind a performing first. You do not want to buy a non-performing second mortgage behind a non-performing first mortgage because you'll get wiped out. If they foreclose, they can very easily wipe you out. Now, some second lien holders like being behind it because they can reach out to the first lien holder or foreclose in a junior lien position, foreclose subject to the first, take over control of the property, and then take over the first mortgage and start paying subject to, or look to list the property and get paid off. Now, that only works really well if you are under encumbered, means there's more equity behind, over encumbering the first plus the second, or more so covering above what you paid for the second. All right, so people are buying large seconds. They're not fully covered, or the balance is not fully covered by the equity. That's okay, because if they paid $4,000 for the second and there's $40,000 covering that $80,000 second, you're still going to get $36,000 in profit. That's still not a bad day at the office for a lot of people. Some people like to try to buy the seconds and then go after foreclose subject to the first, take over the property after evictions, and then work on taking the property down and selling it. So that's the second place. Now, second liens in the past couple of years have gotten more expensive as property values have continued to increase across the country. They're no longer negative equity loans. A lot of times you see a lot of properties that had first and seconds on. Now the properties appreciate above what's owed between both the payoffs for the first and the second. That means for pricier second lien pricing. You often don't see second liens on properties really below $100,000. Sometimes you will, but there's not much. Most of the second liens you'll see are on higher valued assets for the most part. Now, a lot of people love seconds, have loved seconds for years because they can often buy them very cheap because they're in a riskier position in a second lien position, a junior position. And oftentimes you would have had to buy a portfolio of seconds to really have them work out for you well. Everybody should tell you that, hey, you got to buy at least probably 5 or 6 seconds to have 2 or 3 that work out for you, and the remaining 2 to 4, 2 to 3, whatever it is that you put in a file cabinet and wait for either the seller, the owner of the property, end up selling the property. They need to come to get you get a payoff from you, or they're looking to modify or reinstate or do something. As long as you're in a second lien position, it's not a bad place to be as long as behind a performing first. Now, if you've got the money, you can put it, sock it away and not rely on that money. That's not a bad transaction. But if you need to make money, I don't think you can afford to invest in something that you got to sit away for 12, 24, 36 or more months and sit there. I don't think that's a good investment. I want to try to be in and out of my investment in 12 to 24 months at the worst case. Some second investors, they'll talk about high returns, but they pay cheap for the mortgage and they set it aside. And it wouldn't necessarily be if you got to wait 3 years to get paid in that deal, that's usually not a good return on your investment, or you're going to be eating a lot of ramen or peanut butter and jelly sandwiches, if you know what I mean. Okay. Seconds can be great cash flow if you get it modified because you did buy it at a cheaper price, and often a good return on investment because they're in a little higher interest rate loans. And that's the beauty. You get it reperforming, you paid 5 cents on the dollar, and you're going to get them to reinstate at 50 cents on the dollar. That's still a 50% return or better, depending on what the money looks like. Like I said, the thing about thing you got to keep in mind too is that a lot of the inventory of the seconds have dried up over the last couple of years because there's not as many seconds left available for those to get rocking. There's not as many of those out there available for you to purchase. Maybe 1 out of 10, 1 out of 20 mortgage or loans first originations had a second behind it when I was doing loans. That doesn't mean that people I'm going and got lines of credit. That's a second lien. That's a junior lien or home equity line. Thing you have to be careful of, though, is in BK, in a bankruptcy deal, oftentimes the seconds can get stripped off and removed from the property. That's a risky place to be. So that's something you really only want to be buying seconds behind a performing first if there's some equity, and hopefully the borrower isn't filing bankruptcy on it to wipe you out. Okay? What was I going to tell you that next? So we covered non-performing first, non-performing seconds. Let's talk about the next thing a lot of people like looking at is what's been hot the last couple of years have been contract for deeds. One of the great things that you can do with contract for deeds is, let's talk about them. Contract for deeds kind of have been around for a while, but what they have seen more so is they've really become popular among the note investing community because a lot of the sellers or a lot of the buyers of a lot of the low-hanging REOs, especially the large portfolios REOs the last few years, well, one of the ways they were doing exit strategies was to go and offer up owner financing via a contract for deed. And you got borrowers that are putting $1,000 to $2,000 down, or maybe less, and getting a 30-year mortgage on the property, but they don't actually own it until the property's paid off. You see this on a lot of $50,000 or sub $60,000 valued assets because most banks aren't going to give a loan for that little amount. It's really hard to make any money that way. And it also allows for the seller of these assets or the fund the right to evict a lot of times versus foreclosing. Now, that's not 100% of the case across the different states. Some states, depending on how much you put down, you got to go through a full foreclosure. But it still leads for a great example. Hey, no pay, you no stay, evict, turn around, do it again, get a down payment, and hopefully try to have something on there. And we've been pretty fortunate. We bought a lot of contract for deeds the last 2 years and had about a 65% reinstatement or modification rate where we get the borrowers to start paying. Because we look at it as a non-performing first lien, although we control the property. So those are things that have been pretty attractive about it. That market is also starting to dry up a little bit as a lot of people have gotten in, and then some of these bigger funds that bought these large portfolios have been selling off their inventory and getting out of the business. There's also some legislation out there in different states and trying to make it a little more difficult to sell on a contract for deed. That's okay. They're going to end up grandfathering in the ones that we have. But if we end up looking to originate a new one, they're probably going to want us to jump through some hoops. So our goal isn't necessarily to turn around and rinse and repeat. We'd rather sell the asset off as an REO and recoup the cash and go on from there. But contract for deeds, higher interest rates, 9.9% interest rates on these most of the time. There's a lot of inventory. You're usually buying these at somewhere between 30 and 40, sometimes 50% of unpaid balance, which the unpaid balance is usually based off a couple years ago. And there's often a sizable amount of equity between the unpaid balance and the value of the property, which works in your favor when you're reaching out to homeowners. Hey, you've got some equity here. Now you want to stay. Let's work to keep that. It works in your favor, too. If they don't pay, and you don't have to keep you evicted. Now you've got a lot of equity between what they owe and the value of the property. Because the equity a lot of times is whether you've got to evict or foreclose is based on how much of a down payment they put down at the beginning of the deal, not at the end, not where they're at now, but the beginning. All right. That's a great, great thing, right, everybody? It's a beautiful thing. I like it. So nice thing, like I said, contract for deeds. You see a lot of that lower value stuff, pretty relatively easy to raise cash. The thing you got to be careful about a lot of these contract for deeds that you'll see are out in rural areas or small towns. So when you're looking at your assets, so you're looking at a tape of contract for deeds, you still want to make sure it's occupied. Usually a vacant asset in a rural or small town usually doesn't stay in very good shape very long. So those are a couple of things to check at with that. Obviously, you want to make sure that you're buying at the right price. You want to check each state's foreclosure laws or eviction laws when it comes to contract for deeds, because each state's a little different. But I like occupied assets. If I can find them that are occupied and the payments make sense, it's a pretty easy initial bidding process in the front end to run some numbers and numbers down a spreadsheet to figure out what our initial bids, and then waiting for the hedge fund to respond back on what we are looking to buy. Now, the third place besides non-performing first, non-performing seconds, contract for deeds, let's take it over to performing notes at this time. Performing notes. A lot of people like performing notes because they don't want to do the work. They've got an IRA, whether it's self-directed or a solo 401k or something like that, or they're in age, they want to do any work. They want to see a good return on investment. Now, good can vary. Good can be between 8 and 15%, depending on a person's risk. If somebody's getting 0 or less than 1% in a CD, heck, 2% would be good. So what you have to look at when you're looking for performing notes for your portfolio is be realistic. The most oftentimes that a fund or an investor will sell a performing note off to somebody at is somewhere between 12 and 15% yield. That's basically taking the 12 months of payment divided by what you're bidding to yield a 12 to 15% yield. That does not say you can't find them higher than that. You may find them less than that at 8%, because the fact is, hey, if your money's not getting anything, oftentimes investors that have done some work, like myself, worked out the asset, we'll sell a note off, but we'll keep ourselves involved in the deal. I'm glad to pay an 8% flat return on your money and leave some equity in there. Maybe we're splitting the payment stream coming in. That way, if anything goes south, you've got somebody to jump in and help kind of get it back online or handle the work. I don't like selling performing notes off and just walking away unless somebody's got a history of buying notes and they've got their servicer, they've got everything set in place. That means I'm not opposed to it, but I just want to make sure that somebody's not going to get it over their head by me selling them a performing note that goes non-performing in the next 90 days or 120 days, and they don't know what the heck to do. That becomes a bigger pain in the ass in the back end. For me, that would be for anybody. So think about this. If you're looking to boost your ROI in your IRA and get somewhere around an 8%, 9%, maybe 10% return, performing notes is not a bad way to go if that's going to make you happy. If you want a little bit more aggressive, then you may want to look for non-performing notes that have become reperforming that are being sold as performing notes at a 15, somewhere between a 13 and 15 yield on your money. Performing notes, nothing wrong. That's why part of the reason I like non-performing notes is I buy those at a bigger discount, get them reperforming, so my yields are looking pretty good on the back end after we've got the bar paying on time and then looking to sell that note off after a while. That's one thing you have to keep in mind. Oftentimes, you're able to pick up performing notes from either self-directed IRA investors or also other investors who've done some workouts and then have worked hard to get the bar paying on time. A big caveat I would tell anybody is looking to buy some performing or semi-performing notes is make sure they've got at least 6 months of payments on time. Make sure they're going through a third-party servicer. Make sure that the bars put some skin in the game to get reperforming. If they don't put any skin in the game, there's no incentive if things get a little rough for them to stay around. So that's the biggest thing. Also, if you want to, make sure your yield's off of your stuff. Make the borrower pay for the servicing costs. It's not that much extra, $20, $30, depending on the servicer. Once the borrowers made usually 3 on-time payments, most servicers will reclassify it as a reperformer or performing at that point. So it saves money. But you can have them pay the PI, TI, and S. PITIS, principal, interest, taxes, insurance, and servicing. Nothing wrong with that at all. Okay? Now, another thing to keep in mind as well is when you're looking at performing notes, hey, you may want to leverage your account a little bit. If you've got 100, you may want to leverage 250 so that you've got a yield. So if one does go non-performing, you still got something coming in. Be careful about this. Make sure if you're using your self-directed IRA, you got to be careful that you're not using all the money in your self-directed IRA, that you're leaving some money in there extra that can be used to pay for servicing costs or foreclosure costs if you need. You're going to want the payment stream to go back directly to the IRA because you can't touch it unless, of course, you're beyond the age to start taking withdrawals, or you've got mandatory withdrawals if you're, I think, 70 and a half or 70. Check with your self-directed IRA. as always, we recommend Quest IRA to help you out with that. So let's, once again, non-performing first, non-performing seconds, contract for deeds, performing first. Now, we've been talking about institutional paper for the most part here. One of the things as well is what I've talked about so far has been residential. We'll look at commercial notes here in a second. But a lot of people like buying owner finance notes. Now you have two types of owner finance notes. You got performing and non-performing as well. So that's why I always tell people, like, yes, it's good to know performing, but if something goes south in the non-performing, you're going to want to know what you have to do as well. Nothing wrong with buying a performing owner finance note. There's nothing wrong with buying a non-performing owner finance note. Nothing wrong with it at all. I advocate, although what I like, though, is I like getting more in one batch from a hedge fund or a bank in the non-performing institutional debt. Now, if you're buying an owner finance note, you're going to probably see one note from an individual. You're not going to see a larger inventory. There's nothing wrong with it. If you like going after homeowners who've owner finance property to either tenants or new buyers, that's totally fine, completely fine to do that. You just want to make sure that if the note was written after January 2014, that it's Dodd-Frank compliant. Now, what does Dodd-Frank compliant mean? It means a registered mortgage loan originator reviewed the notes, reviewed the borrowers, and signed off on it. It's important. Now, if the loan was originated prior to January 2014, you don't have to worry about that. It could be written on a napkin, piece of paper. Not necessarily saying that I would want to buy that note, because I still evaluate an owner finance note very similar to how I underwrite the paper or the mortgage, a non-performing or performing note. I'm going to want to see, copies of all the documents. I'm going to want to see some financial documents, seeing what the borrower put up. Copy of the deed, copy of the mortgage, copy of every assignment of mortgage that mortgage has been sold a couple times. I want to see allonges along with that mortgage every time. The more that owner finance paper looks like a traditional mortgage, the happier I am. Another big caveat is I'm going to want that owner finance paper to be serviced with a third-party servicer. Yes, I know there are a lot of states out there that will allow you to service some of your own notes. Texas being one of those states that if you do your own owner finance, you can self-service. I don't like it because there's nothing that I can go check. Oh, yeah, here's a copy of the pay stubs or copy of the canceled checks. Yeah, that's not the same as being able to go on and print out a statement from a third party like Madison Management or checking a portal out. Okay? It's not the same thing. Now, if you're going to be originating paper, obviously you want to make sure that the borrowers make it affordable. You don't want to make sure that they're over like a 40% debt to income ratio. Make sure that the note isn't written for a lot more than what the property is worth. That's a big mistake I see with owner finance notes. I see people write a loan for $115 on a house that's worth like $100 or $110. A little bit extra, okay, but if you start adding $10,000, $20,000, $30,000 over in the balance of the mortgage whatever the property is worth, if you try to sell that note, you're going to take a discount regardless. I'm not going to pay above property value for a note. That's what you have to keep in mind. Now, one of the better ways if you're going to be buying owner finance notes is you're going to definitely want to see a skin in the game from the original borrower. And I would say at least 5% or greater, prefer 10. Now, in a lot of cases, going back to my loan origination days, I would structure deals a lot of times with the borrowers be 5. Okay, they got 5% down. Then we're doing a 70% first lien, a 15% second lien for the 5% down payment. I'm going to want that first lien balance really, especially if it's split up like that, not to be any greater than 80 cents on the dollar. Why is that? Well, it's a lot easier for that borrower, if they've got a higher interest rate, pay their payments for 12 to 24 months. If they look to go get refinanced out, maybe they've got an interest rate at 6, 7, 8%. It's not unheard of. It's not overly charging either if you're going to be the bank. That gives them the nugget. That gives them the carrot in front of their face to go out and get refinanced out with a traditional bank loan without you taking a big discount on the back end. Hey, if your first is at 75 or 80, that's a great LTV. You're carrying a 15 to 20% second. Hey, keep that second for cash flow. Or sell it off at a discount. Or sell it off on partials. There's a variety of ways to do that. Nothing wrong to do that at all. I know plenty of people are buying owner finance paper, and that's great. You can still get a pretty decent yield. It all depends on the yield you're wanting to get. So one of the big mistakes I see a lot of people that originate paper put like 5% interest rate. Well, that doesn't make any sense because if I want to get a 10% return on my money, the most I'm going to offer you on the payment stream or on that whole mortgage is 50 cents on the dollar. to get my 10% return. I'm going to offer half to double my yield of the 5% coupon rate. That means 10% is only paying 50. That doesn't mean you're making any money if you're owner originating, especially if you've done a rehab on it or put any work into it, or overpaid for the asset. Everybody gets excited. Oh, I'm going to create paper on my fix and flips. Maybe you don't want to do that. Maybe that should only be your last resort if you can't sell it. And then I would definitely structure it, like I said, 70, 75 first, 15 to 20% second, and then a 5 to 10% down payment. Hopefully, the more you get down payment, the better. All right, and you can do 5-year loan on a 30-year loan with a 5-year balloon. You can definitely do that if you want to. Nothing wrong with that at all. If you're doing your one, you're allowed to do that. If you're getting more, you're doing more in one, then you got to be careful out there. Make sure you're Dodd-Frank compliant. And like I said, it's still best to service that loan with a third party so that everything can be verified as far as payment streams and stuff like that. So the thing you got to keep in mind, is there is non-performing owner finance notes out there. Same thing. Be careful on that stuff. You're still going to discount that depending on where they're at. There's a great thing that you can do. I think they're great investments as well, as long as you're doing your due diligence, double checking anything, making sure the value of the asset is there. That's the important thing. And then making your offer off of a discount of the property, depending on how long the foreclosure process is. There's some other great things that you can do. All right, with that aspect. But double check, always verify. Like I said, check to make sure there was title insurance purchased, a mortgage insurance policy in place when it was originated. That's an important thing to look at. Always add that stuff to it if you're originating paper. Some people won't do that because they're the bank. Oh, I don't need a bank policy. Yeah, you probably do just for the heck of it, especially if you're doing an owner finance deal where it's a wraparound mortgage around it first. What else am I going to say on that? Double check your values, check your title insurance, always pull an O&E report, ownership and encumbrance report across any asset you're buying. It goes, of course, for contract for deeds, firsts and seconds that are non-performing. Let's see, what else did I want to add? One of the great things, too, I would do, like I said to everybody, is if you can sell the property without owner financing, you're going to recoup more money immediately and be able to go double down. A lot of seller finance educators like to talk about, oh, you're going to make all this money in interest. Yeah, but if it's my interest rate on the mortgage is 6 to 8%, couldn't I be making 20% by taking my money and the velocity capital kicking in? So that's the thing I look at as well on that aspect of it. So just be careful, double check it, make sure you look at your full opportunity cost before you owner finance. And then also, if you're going to be buying for your own portfolio, make sure you double check everything on that first or that second owner finance mortgage to make sure that you're not going to end up holding the short end of the stick. All right. So that talks a little bit about first lien, second liens on non-performing, contract for deeds, owner finance first and seconds as well. Let's talk a little about partials. Now, partials, you have that happen a lot more with owner finance notes than you do with institutional debt. No bank's going to sell a partial loan off for the most part. Now, you can often sell some of your notes off if you've been able to modify it as a investor. There are funds out there will buy partial mortgages. They either pay 5 years, 60 months, or 12 months. Our buddy Tom Henderson up in Dallas is saying, hey, I'll give you 10 months of payments for 12 months. I'll give you the amount for 10 months of payments for 12 months. 10 for 12. That makes sense. Other people will pay for 24 months. It all depends on the kind of what you're looking for. A lot of people will use partials to raise capital to take other deals down. And that's fine. There's nothing wrong with it. You're just giving up payments for 12, 24, 60 months, depending on what you're looking to. The thing to keep in mind with partials is a lot of people would prefer to take the whole loan down. Okay. I think partials, and this is my opinion, and my opinion only, it's my podcast here, the Note Closure Show, everybody, that I think partials is the most overhyped aspect of the note industry. Now, if you're going to be buying notes, it's trying to sell notes to like our buddies over at First National Acceptance Corporation, FinacUSA.com, one of the biggest buyers of owner finance notes out there. they'll look at and offer a bid for the full note most of the time or partial. If they don't really like the full thing, they'll look at the partial thing. They'll give you the options. Heck, if you want to broker owner finance notes, that's a great place to broker to because they'll work with you. I've done like 2 partials in my day. It's not saying it doesn't happen, not saying it can't happen. Partials is a great thing to do if you're using your own self-directed IRAs and you don't have that much funds. It's a great way to build it up by being able to buy 12 months of payments and get a yield on your IRA. It's also a great place to go buy to raise capital, like I said before, if you just want to sell a chunk of the cash flow off versus the full asset amount. So those are some things to keep in place. Partials, you can get really great with your HP 10B2, your financial calculator. There's some great things to look at and go from there. And if something happens along the way, bar stops paying you foreclose, you get paid back sooner, and you're still sitting there pretty. So partials are critical to make sure you do have a third-party servicer that's handling stuff. And yes, most of the third-party servicers, if you sell partial off, can direct your payments to be wired directly to whoever paid you for that chunk of payments, or paid to you if you're the payment stream buyer. All right, that's partials. Now, let's talk about another thing a lot of people don't talk about in the note space, especially in the aspect of it, is you have you have subject to deals. You also have wraparound mortgages, which kind of fall on the owner financing. So first thing I'm going to do is talk about the owner financed, wraparound mortgage space. This is kind of what I call it. This happens a lot if somebody's trying to sell a house, they can't sell it, and they may have a little bit of equity or no equity or have a very, very low interest rate. They may do a wraparound mortgage. Say I got a 4% interest rate on a mortgage, $100,000 is what I owe. House maybe is worth $120,000. I could owner finance that loan with a wraparound mortgage, say at $120,000 for 6%. So I now have a difference between the 4% interest rate and the 6% interest rate. That's 2%. And the difference between the principal and interest payment between a $100,000 mortgage and a $120,000 mortgage. So if I'm the owner of the property and I'm owner financing and I'm taking the payments that are coming in from the wraparound second at 6%, should be a nice chunk of payment. If I'm applying that directly to my mortgage all in full, I should be writing down the mortgage balance under the underlying mortgage quite quickly. So I'm building a little bit of equity faster between what my buyer, who is buying it at $120,000 at 6% interest rate, is getting. So I'm able to pay down my principal faster. And the beautiful thing is if they don't pay, then you have the right to foreclose from, as the lien holder, since you did the second, you have the right to foreclose, take the property back and start all over again. I would never, ever, ever do an owner finance deal, whether it is a traditional owner finance or a wraparound mortgage, if they don't have any skin in the game. Always got to get some down payment. At least 5% is the preferred. Now, once again, still would want to have a registered mortgage loan originator take a look at it. A wraparound mortgage, make sure you're not offering usury, too high a rate, not making it too high above what the property value is. Okay, you want to try to write these with the idea that they're going to work out for you, not with the idea in mind that you're going to foreclose and take it all back. Okay. Subject to mortgages, subject to deals is really kind of buying paper as well. It's not really technically buying, you're just taking over the payment stream, not assuming the loan because the mortgage still stays in the borrower's place. But subject to deals are starting to pop up a little bit. When we see a downturn, you're going to see more of these pop up. Think about a subject to deal. The way to make capital or make money on a subject to deal is, once again, to either make sure there's a chunk of equity between what you owe or what the property value is worth, or it's a low interest rate even if there is no equity. So a mortgage payment on a $100,000 mortgage at 3% will be a lot less than it is at 6%. You've got that 3% spread there. So that's one way to look at, hey, I'm going to take this over, cheap interest rate. I can owner finance 6 to 8%, make a difference on the spread. Okay, great. I took over the existing mortgage. It's in somebody else's name, but you'll see that happen when people got to move or they're stressed or in a divorce situation. There's a variety of different factors that can cause that. Now, what's also nice, a lot of people will take our subject twos and then turn them into rentals. And that's another way to look at what's going on. Hey, maybe there's not a lot of equity, but there is a sizable difference between what the PITI payment is and what market rent would be. So if market rent on a $100,000 house at 6%, say it's around $700, $600, but market rent is $1,200. If market rent $1,200 and you take away your taxes and insurance, you're still going to have a couple $100 a month in cash flow there. That's not a bad day. I've known several people who have used subject to deals to take down and build a nice rental portfolio. The borrowers on the original mortgage, they didn't care because they were either A, going to go in default or motivated to get out from under the property. Now, they still have that mortgage on their credit in the subject to deal. You want to make sure in your documents, if you're doing a subject to deal, that you very, 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 very big bold letters or big description verify the fact, hey, this is not getting rid of the mortgage on your credit profile. They're still liable for that. So if you don't pay the mortgage, it will worsen their credit situation. So be careful about that. All right? Important to keep that in mind when you're thinking about a subject to deal. Now, subject twos, I think it's great. It's like somebody giving you property, walking away. The only thing about a subject to deal, you make sure that there is not a huge outstanding balance. That doesn't mean it's a bad deal. I've bought properties that were subject to deals that we took over the mortgage for a year, and we brought money to the table. We brought some money to the table to pay the rearages, to keep it from going to foreclosure because it was such a nice equity spread in the back end. So always make sure that you want to make sure that on a subject to deal that you have the borrower add you on as a contact data. You want to also make sure and add that onto the insurance. Some people will say, well, what about the subject due on sale clause? Look, as long as the bank's getting the payments and they've been notified, hey, so-and-so, if they start receiving checks, and there's a way to do that creatively that we've done before where we send in a check from us and say with a letter, hey, so-and-so is making a payment. We've never had the check returned. So if they ever come back, oh, you sold the property, took it over, like, well, hey, you've already accepted payments from me. We sent you a notice to the notice department. We've informed you of that. No judge is going to rule against you on that aspect for the most part because you did your stop. You sent in a letter, you sent in payment, they've accepted the payments, and then you go from there. That's the beautiful thing about those. So once again, subject to deals, not a bad thing. Wraparound mortgages, not a bad thing. Just got to know your numbers, know how to set those things up, and more importantly, use, like I said, close with an attorney. Always have a real estate attorney review your documents and make sure everything is cordial for your state. Don't be using a generic form that you've downloaded online and trying to do it all yourself. Spend the $500 or $1,000 it's going to take for you to document and create it well. The last thing you want to do is make an $80,000 to $100,000 mistake because you were cheap and didn't want to pay for a form or not pay a couple $100 to have an attorney do their job for you. Okay? Now, another important thing to keep in mind here, I think it's important, is you also have to consider what's going on in the market. All right? Markets are changing constantly. If your market is in a depreciating market, you probably don't want to take over some subject to deals, especially if they're losing equity or losing value. Same thing with an owner finance note or a wraparound mortgage. You probably don't want to be doing that in a market that's starting to drop because the borrowers will lose motivation to keep making that mortgage payment if the market's dropping. Now they're over encumbered. They've got a mortgage that's more than what their house is worth. That's not a fun position to be in. I think we can all agree to that. So a couple of things to keep in mind for that. Take a look at what housing prices are going, looking at comps, looking at days on market. This is why you want to talk to realtors to pull comps. You want to talk to realtors in an area, see what's going on. Now, none of us have a crystal ball. We can't predict the future, obviously. But you can by use of looking at realtors and looking at adamdata.com is a great website, ATTOM, adamdata.com. It's a great website to look at for that as well, to kind of see hot markets, cooling markets. You want to track your foreclosure numbers in an area too. One thing that I look at is I try to avoid areas or markets where I'm seeing a lot of, 100% financing or $500 down gets you into a house. If you see a lot of houses in those areas, those are often, especially on new builds, those are places that default relatively quickly. Why do they default? Well, you have people that move and buy a house, and the tax value is based off the raw land. It's not based off of the raw land plus the improvements of the house. So come April, come February, come January, when the tax value of the house is reevaluated, and their escrow accounts are now, their tax amount is quite a bit higher, their taxes boost things up. Many people, unfortunately, are budget mindset. They get in a house for as little as they can get so they can make it affordable, but with a $200, $300 increase in their mortgage payment, depending on the area, depending on the state, obviously. Texas, we're a little higher here at 2.6, 2.7%. That can really lead to them being in a bind in the first 6 months. That can lead to them being defaulted in 90, 120 days, depending on when they buy. So be very careful. If you're around some of those neighborhoods, those foreclosures, those defaults are going to affect the property value of the asset you're looking at. That's not saying you can't go and take over some property if they've got really cheap stuff. You just got to make sure that you're able to afford it, or that's an area there's a nice enough difference between the mortgage payments and what the market rent rate is. You don't want to end up, and I say this as a voice of experience from early on in my business career, especially my real estate career. We got into a couple investments we thought were going to be rentals. The only person that made money on those deals was the realtor. We couldn't rent it for what we owed on the property. We were behind on it, and we had to sell it. Had to get out of those assets ASAP when the borrower stopped paying, or when the market rent rates dried up a little bit. When there's a lot of vacancy, what happens? Market rents drop. Your rent rates are going to drop definitely with that. So keep that in mind. You want to make sure you have a buffer. Make sure you've got a buffer between that if you're going to be investing in those areas. Look, there's nothing wrong with buying those areas. Just make sure you're careful. Make sure you know what's going on around you. Drive the markets, drive the areas. Don't just look at what the block is. I'll give you another example. Like in Memphis. Memphis is going through a lot of blight in the area these days. You really need to know Memphis on a street-by-street basis. It used to be okay zip code-wise. That's not the case. You really know on a street-by-street basis, because one block will be extremely nice and great, and the next block over, it's going to look like ass, okay? It's going to look ugly. So those are the things you got to keep in mind, that it's important, it's important. They don't talk to you about it. They don't teach that to you most of the time out there. Oh, it's great. Let's buy this owner finance or take this over subject to. No. Last thing you want to do is take over subject to deals that you're upside down and not making money on. I've had students, well, not my own, but students come to me where somebody taught them, hey, this is a great deal, take them over subject to. I'm like, what? That doesn't make any sense. The only time it makes sense if it's in a market where you've got a ton of equity and you can sell that asset off and make some money. But you don't want to hold on to property that you're upside down on, or you've got negative rates coming in. That's not a smart place. That's not being a real estate investor. That's being a divestor. You're devaluing your amount. Your money's losing. You're losing money every month. Does that make sense? Hopefully it does. So another thing to keep in mind when you're looking at that stuff is just be smart. One of the great things to look at too, and I was talking with somebody in, where was I at this a couple weeks ago? I was talking to, it was in Tampa at a recent lunch and learn for 5 hours. And they came in, she's at a house. Oh, I want to offer up owner financing. I'm like, okay, where's that? She goes, it's in Georgia. I go, where do you live? She goes, California. I'm like, okay. How much is the borrower putting down? Oh, not much. I said, okay. Does it need work? She's like, yes, it needs a lot of work. I said, okay. What's going to happen? Well, they're going to do the fix and flip themselves. Wait a second. Do you have a bid on the workout? Do you have a bid on what's going to be repaired, how much money they need? No, they're going to do it themselves. I go, that's not a smart place to be in. If you're going to offer owner financing, you want to make sure that they put some skin down, obviously. B, that they have the repair costs either in their accounts already, on a credit card, or something they can pay for the repairs. Because if they don't have that repairs, they're going to do it as they go. They're not going to get it done in a timely fashion. So in that case, I would recommend, here's what I would recommend. This is a money nugget for you. Should have pulled this out earlier. If you've got an ugly property that needs some work out, I would reach out to your local hard money lender and see what they would finance as far as for the acquisition of property and any repairs. Because they'll often know by looking at an asset, hey, this is going to need 20 grand repairs or 40 grand or 50 grand repairs to get it up to where it needs to be with an after repair value. They will often, a lot of hard monies will often pre-approve a project for financing. Oh, yeah, will you approve 75% of that plus this for repairs? That's great. They're pre-approved. Then you just market the asset out to them, or tell your borrower, your potential buyer/borrower, to say, hey, I'm not going to finance it to you, but you can go get financing from the hard money lender and then buy it from me and have funding in place. And then you, as the property owner of the ugly property, can walk away with your money and not having to worry about if the borrower is going to not be able to pay because they can't get the work done. So that's the thing I see a lot of people making mistakes on. I've bought hard money loans before where people were unable to make the payments. They were going to do the repairs, and the seller, the fun one was to pay par at $77. I was like, I'm not going to do that. we're going to pay a sizable discount because you are not smart enough to figure out the numbers on this and to pre-qualify your potential borrowers and rehab crews. So be careful about that. That's something you're going to be looking at doing. It's a niche out there. I think when the market turns south here, there's going to be a lot of hard money loans available that you can pick up as a great little investment at discounts, and then either finish the rehab or work something out with the existing borrowers to extend the loan if they're paying, or take the property back, cash for keys, and then selling off as an asset. I just think that's a well-designed play here in the next probably 12 months. We're already starting to see some of that out there as well, because hard money lenders are starting to pick up the phone and say, hey, would you buy my portfolio? What's going on with it? Same thing, same type of due diligence, same time to checking it out, making sure the numbers make sense in case you've got to take that property back yourself. All right. So let's do a quick recap again here. We talked about non-performing first and seconds. We talked about contract for deeds. We talked about owner finance notes for, what you're doing first, second. We talked about partials. We talked about CFDs. We also talk about kind of wraparounds and subject twos, two different things. All right. I'm just talking about now, commercial notes are a whole different ball game, whole different flavor. I would not buy a commercial second. I'd only be buying commercial liens secured by real estate. I had a portfolio sent me today where it was a business loan, SBA loans, that did not include the property. I'm not going to buy those loans. I want to buy the building. I'll buy commercial notes on commercial properties. Same thing goes. You got to look at the values. Thing with commercial notes, you've got to make sure that the cash flow is there. It's all about net operating income and cap rates with that stuff. So if you don't have the rent rates, you don't have the leases in place, it's going to depreciate the value of that asset. Now, if there are long-term tenants in place and you've got the cash flows and all that stuff, the rent rates to go along with it, hey, it makes it for a more desirable asset. There's still some opportunity to make some things happen. I like dealing directly with banks on the commercial side because they know what's going on. Often they'll have the paperwork. They'll know their rent rates. They'll know the rent rolls. They'll know what's going on with the asset. And depending on the balance of the loan, they may often move the loan from the non-performing side to the performing side if you take over control of the asset. So we've had that happen a couple of times. Been really, really nice. Anything that's sub-million in value or balance, they usually want you to move off the books and find somebody else to come take it down, but they'll offer discounts, especially if it's non-performing for a while. There's also the scratch and dent stuff out there where borrowers are on time or late, but get caught back up. They can get stuff at a discount. And that's not just the case with commercial notes. You'll see that with institutional debt and bank debt also on the residential side. But one of the beautiful things about commercial loans is if the borrower is not paying, but they have tenants in place that are paying, you as the bank oftentimes have the right to go and collect the rents, right to collect rents. And it's all rental clause in the mortgage, the commercial loan allows for the bank to go do that. It takes away a lot of the motivation from the borrower who's not paying to get working with you to do some sort of workout or modification or do something to get taken care of. I would highly recommend, though, each commercial asset class, whether it's mixed use or big box or medical office or self-storage or apartments or whatever, each one's a little bit different. Hotels, motels, throw that in there. It's a different class of each asset. So what I would highly do, if you find something, is reach out to an expert in each of those fields or each of that individual asset class and have them work with you on the deal. It's better to get a part of something and gain a lot of knowledge about a commercial asset versus get 100% of nothing. And oftentimes the banks do not want to turn over a sell note to somebody who doesn't have any experience. So you don't have to have a lot of experience, but if you show on your team, hey, I've got this team member who's doing all this turnaround with self-storage or doing this stuff with golf courses or whatever, as long as you got teammates that show that, that will add value to you and value to the banks looking to work with you. Okay. So no, I've covered a lot of stuff on this episode. Hopefully it was very valuable. One of the great things being in the real estate industry, golly, going on for 15 years, we've seen a lot of different things and invested in a lot of things and bought and successfully sold some things. It's not to say we haven't had our ups and downs. It's just we had deals that have gone south. We just continue to rock and roll and keep going forward. So like I said earlier on, if you'd like to find more information about what we do at WeCloseNotes.com, just pull out your cell phone and text the word notes, NOTES, to 72000, 72000, and we'd love to add you to our database. Or as always, you can go to WeCloseNotes.com and check out all the different things that we offer there as well. So thank you again for listening to the Note Closer Show, whether you're listening to this on a replay on any of the different podcast platforms. You're listening to this on any of our 16 different AM FM radio channels across the country, from Tampa to Long Beach and everywhere in between. We thank you. I always encourage you also, if you're interested, reach out to me. Drop me a text message or drop me an email. My email is very easy, scott@weclosenotes.com. Mention that you heard this episode. I'd love to visit with you. Or you can shoot me a text message at area code 512-585-3810. Yes, 512-585-3810. That's my direct cell phone. Would love to hear from our listeners. Otherwise, go out and make something happen, everybody, and we'll see you all at the top. Bye.